Okay, in this video, we're going to walk through some of the exercises in chapter 13. So this first one has us estimate production and then raw materials that will need to be purchased to meet those production levels. So we have this novelty store produces drink coasters. During the current year, they sold 520,000 units, packages of 6 coasters. In the coming year, they expect to sell 540,000 units. In year 2, it expects to sell 624,000 units. The target ending finished goods inventory for each month is equal to next month's sales. However, because of production issues, the ending inventory in the current year is only expected to be 12,000 units. Each unit requires a half a pound of cork, and at the end of the current year, management expects to have 18,750 pounds of cork in their inventory, and they have set a target to have cork on hand equal to 1/2 of the next month's sales requirements. Sales and productions take place evenly throughout the year. So compute the targeted production of the finished coaster for the upcoming year. So in the coming year, they expect to sell 540,000 units, but they're starting with 12,000. So their beginning inventory is 12,000 units. And then their expected sales are 540,000 units. So then what we really have to calculate is that middle one. What's their desired ending inventory? So if the next year's, say in year 2, they expect to sell 624,000 and their desired would be to equal 1 month's sales. So then that's what they've calculated down here. So year 2, 624,000 divided by 12 months, they would want to have 52,000 units in their ending inventory. So their expected sales plus their desired ending inventory means they should have 592,000 to produce. They currently have 12,000, so that leaves 580,000 that they need to make. So then if that's how much they need to make, then how much material do they need? So if we go back up there, it tells us that each unit is a half a pound of cork. So we're going to factor that in times the number of units we need to produce. So then we need 290,000 pounds of that cork. Then how much ending inventory do we want to have for that? So we want to have 1/2 of next month's sales requirements. So then we come down and say, okay, again, we get to the 624,000 divided by 12, which would be the 52,000 times half times, so that'd be half. That'd be like half of what we need to have. So that would take it down to what, 26,000. But then we don't have a pound per unit. We have a half a pound per unit. So then we're going to multiply that by another half. So this 50% here has to do with the fact that we want 50% in the ending inventory. This 0.5 has to do with how heavy or how much weight, how much pounds we need. So then we would need 303,000 pounds. We currently have 18,750 in our current inventory, so we would subtract that out. So we'd have to purchase the 284,250 pounds. Okay, then we're going to estimate our purchases and our cash disbursements for our cash budget. So Montrose has a policy to hold in inventory enough of the component to produce 3 months worth of sales. One component is used for each unit of product. On February 1st, the company has 30,000 components in stock. The sales for the unit in which the component is used over the next 6 months are estimated as follows. The parts are purchased at wholesale for $45. The vendor has a financing agreement that pays, in which Montrose pays 40% of the purchase price in the month when the components are delivered, and then 60% in the following month. Montrose purchased 37,500 parts in January. So estimate the purchases of the component in units for February and March, and then estimate the cash disbursements. Okay, so then we come down and say, okay, our estimated sales are the 32,250 and 26,250. So we're just pulling that from that table. Then our estimated ending inventory is going to be what we need for the next 3 months. So again, go back up to that table. So add February, March, and April, right? February, March, and April, or is it March, April, and May? Sorry. March, April, and May, because the next 3 months. And then in March, it would be April, May, and June. So we would add April, May, and June together to get to that desired ending inventory. So then we're going to add those together and then subtract out our beginning inventory, which again is provided to us. They have 30,000 components for the first year, or sorry, for February, and then that 89,500 is what we would need to purchase. Now notice then that this 87,300 that's left over in February rolls over into the beginning balance of March, which again would make sense to do that. So then how do we pay it? So then for February, we're going to be paying the 40%. Let me go back up to the, so how they pay it is in 40% purchase price in the month, 60% the month following. So then the 37,500 parts purchased in January, 60% of those would be paid in February. So as we come down there, that is that January total there. So let's see. So they've calculated the 60% times the $45 per unit times the 37,500 units, and that gives us the 1,012,500. Then that would complete January's. Then February's would be 40% paid in February. So 40% times the 45 times the 89,550 that we calculated there. Then the remainder of February, that remaining 60% is going to go into March. And then March will have 40% of the March purchases paid in March. So we're going to, stagger those out by month and then total them up and then put the totals into there. So then that February would be 60% of January's, 40% of February's. March would be 60% of February's and 40% of March. Okay, then estimating our cash receipts is a similar scenario. We look at how the sales happened during the month, and then how do they pay us. So in this case, it's a mobile detailing company that washes and details their vehicles. It operates on a membership basis. So members pay $200 per month, which entitle them to complete wash and detail services monthly. Members may also order additional car washes during the month at a fee of $75. Additional washes are common in summer and winter, and the number of members also varies with the season. The number of members and the average number of additional washes by members for the month are outlined below. So Cornwall allows members to pay for their dues on credit. Cornwall's experience is that 40% of the members pay cash, 50% pay the dues for a month in the next month, and 5% pay the second month after. The remainder is uncollectible. So then I think that'd be 5%, right? Additional washes are payable in cash. So then we need to map those out. Now they're asking for the months of March, April, May, and June. So then as we go down, we take each month's membership, multiply those by the $200. Then we take the additional washes, which would be calculated again by taking the total 360. So like that, 360 times the 0.8. So 360 times 0.8 gives us the 288. Then the same thing, 420 times 1.1 gives us that 462. So we calculate all of those, and then the revenue at the additional washes is going to be that times $75. So then our total revenue is our membership dues plus the additional washes. Then we're going to map it out by, well, how do they pay? So in March, we would be receiving 5% of January's membership. So that is the 3,600. We would be receiving, what was our next percentage? 50%. Then in March, we'd be receiving 50% of February's, and then we would be receiving 40% of March's. Now then all the additional washes are paid in cash in the month. So then we would just go to, why doesn't it show us that? Oh, I think it's adding that together though, right? Let's see, let's look at C. Yeah, so then C, we had the 40% of the March dues, and then we just added all of the March additional washes to that because all the additional washes are paid in cash in the month that they occur. Then April would be the same way, same type setup. We'd have 5% of February sales coming in, 50% of March's sales, 40% of April's revenue dues, plus all of their additional washes, the 50,400. So again, they're not showing us those mapped out, but that pattern is just repeated. Then May, we would have 5% of March, 50% of April, 40% of May, plus the additional washes. June would be 5% of of April's, 50% of May's, 40% of June's, plus the additional washes. So then we've mapped it out again by month. So March, you'd have that total, April, that total, May, that total, and June, that total. So that's what, and then we would use that to do our cash budget and compare that to costs that were coming out. Okay, then preparing our budgeted financial statements. Again, this is the similar. Is it the same company? It is the same company. So we just have to calculate out their service costs as well as their revenues. But so some of that, I feel like some of that work we did on that last one. But so we're not worried about the cash now. We're worried about just the revenue side because we're doing the income statement. Cornwall estimates the number of members should increase in July 20% above June level, and then the number of additional washes per member should increase by 12.5%. So we're going to have to increase those for that month of July. Okay, so that's all we're doing is July. So we're going to have to look at what their revenues would have been for June and then increased those by 20%, the members, and then increase the additional washes by 12.5%. Then they give us costs down below. We have variable costs, equipment maintenance, depreciation, marketing and administrative. Variable marketing changes with the volume measured by the number of members. Fixed depreciation will remain the same, but fixed administrative costs will increase 10% beginning July 1st. Equipment maintenance is outsourced and the contract calls for a 5% increase in July. So then if we come down to our sales revenue, so if we come down here, we've got 120% of what we had in June. So that gives us the 312,000. Then 120% of what we had, no, is that the truth? No, 112%, let's go back up there. The 12.5% is how much the additional washes are going to increase. So our number of customers times the 1.4 times 112.5% gives us the additional washes. So we would add those, or we'd calculate those out and put that total in there. Our variable costs are going to be, they change with the number of members. So what we have to do is calculate out, well, what are they now? So now they are 44,000 for 1,300 members. So the ratio of July to June is 112. Oh, yeah, so I guess that's, I think that's all it's doing. So it's just taking the 44,000. So I was trying to make it a little more difficult than that. So it's just taking the 44,000 and then increasing it by 20% because it goes along with your number of members. So that makes sense. So 120% times that 44,000. Equipment maintenance is going up 5%. No change in depreciation. The marketing is going to be, again, what did it tell us there? But it is, I think it's a similar thing in that it's going to increase with your number of members. Yeah, so variable service and marketing change based on the number of members. So again, if our number of members go up 20%, that marketing is going to be 120% of what it was. And then our administrative expenses are going up 10% effective July 1st. So then we increase all of those and then we plug those in to see what our operating profit ends up being.